6 undervalued dividend stocks. We're going to take a look at each one of these, their historical performance. We're going to take a look at their dividend safety, going down to their financial metrics. And as always, we will run them through our valuation model, getting to our intrinsic value and our acceptable buy price, given our investor margin of safety. So jumping into the first company, we have Starbucks Corporation. Now this is down around 5% year to date. As we can see, it's towards the mid to lower end of the 52-week range, and it does offer a yield currently of 2.4%. Now, if this is one you've been holding over the last 10 years, we can see without including dividends, it is up around 148%. And we can see towards the middle of 2021, it hit its all-time high of $126. So let's take a look at those dividend safety and the metrics. So straight away, dividend safety score, 67, it is safe. Market cap, 109 billion. It is a mega cap company. Now, when we take a look at those recessionary metrics for those that do see a recession inbound in 24, while no dividend was paid, so we don't have that recessionary data, they did have negative 6% recession sales, which is above the average growth of the S&P 500 during 07-09, which was around negative 12%. They did, in fact, underperform the S&P with a recession return of 69% versus the S&P's negative 55%. What about dividend growth? Well, 7.5% dividend increase this year. That is above the 4% in inflation rate that I always advocate on the channel to get more than. Double-digit increase over the last 5 years, 10% year on year. Over the last 10 years, again, double digits, 17%. So if you've been holding this company over the last 10 years, you have had some strong share price appreciation, as well as that dividend increasing year on year by 17%. And we can also see they've been increasing those dividends for the last 13 years. Now, what about dividend yield theory? Well, dividend yield theory states that the company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation, 2.38 versus 2.01. As we always say, though, we never look at any of these models in isolation, and we'll draw our conclusions towards the end. Forward PE, 23.1, significantly below the 5-year average of 29, so another sign of undervaluation. And we can see it is still higher than the consumer discretionary sector PE at 14.8. Now, when we move on to the free cash flow payout, as always, we do focus on free cash flow. Earnings is susceptible to manipulation by management through accounting. Below 60% is what I look for. You could bring this down to 50% for restaurant industry. 2023, 67%. It is okay. I can live with that. It is above 60%. Do note, though, in 2022, it was 90%, a bit too high in my opinion. But 2024, it is expected to be around roughly 70%. So something just to keep an eye on. Free cash flow per share, well, it was negative in 2014 at negative 37 cents. It has increased since then to $3.20, but we can see over the last 10 years it has been fairly inconsistent, although it is expected to increase very slightly in 2024. Sales growth, well, what we love to see, moderate steady growth at around 3 to 7% year on year. Starbucks, a very strong grower in terms of the top line, double digits nearly every single year, bar that justifiable COVID year, negative 11%, which is very understandable given lockdown, people not able to go and to get their coffees and drinks. How does that look numerically? Well, 16 billion on the top line in 2014, more than double in 2023 at 36 billion. So nice to see the top line growth for Starbucks. Shares outstanding, well, they do share buybacks as we can clearly see. 1.53 billion in 2014, 1.15 in 2023. So they are returning excess cash to investor pockets, as well as those nice dividend growths to the dividend. ROIC, return on invested capital, we look at 10% or more, gives us faith management are able to effectively allocate their capital. For the large part, Starbucks are doing this very, very well. 2023 coming in at 33%, so we do have faith management are able to effectively operate their business. Operating margin, free cash flow margin, a bit more inconsistent. For the large part, it straddles around that 16% that we look for as a minimum in the restaurant industry. Free cash flow margin, a little better in terms of the story to tell here. 10% in 2023 with the last 2 years above that minimum. So margins are pretty strong for Starbucks, but it is something just to keep an eye on to ensure it doesn't slip. Then we move on to the final metric, net debt to EBITDA, earnings before interest, tax, depreciation, amortization. This graph shows us two things, balance sheet strength as well as dividend safety. And these numbers are the minimum number of years it would take the company to pay off all of their debt net of cash on hand. 2023 coming to 2.06, below that 3.5, so that is very strong. So let's jump into the valuation for Starbucks. Now, as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we run through each of these models in quite some detail, talking about the inputs and outputs. For today's episode, we're jumping straight into the valuation calculator. So the intrinsic value for Starbucks is the average of the three models, and this is coming to $111. Now, the current price sitting at $95.93. We typically start off with a margin of 10% if we believe it has a wide moat, strong financial metrics, as well as good forward-looking data. We can see at 10%, it is a buy up to $99. If we extend that to 15%, it is around $1 or $2 shy. So you are getting nearly a 15% margin of safety for Starbucks at the current trading price. What do Wall Street say? Well, they do see some nice upside to the current trading price. In fact, they see around 20%. So in conclusion, for Starbucks, we see near enough a 15% margin of safety, with Wall Street targeting nearly 20% upside over the next 12 months. We then move on to the second stock, which is DEO. Now, this is one that hasn't had the greatest of years. Down 17% year to date, significantly underperforming the S&P, which is up 25%. It is trading pretty much towards that 52-week low and does offer a yield of 2.71%. If you've been holding this over the last 10 years, you would only really be up 11%, and we can see its all-time high at the back end of 2021 at $220. Dividend safety score 99, very safe, the highest score obtainable. 81 billion market cap, we're talking about a large cap company. Recessionary metrics, well, they increased the dividend during the last recession. Positive growth, which is positive to see, and negative 51% recession return, which is near enough that S&P's 55 negative. Dividend growth, well, 5% over the last 4 years, so at least it is above that 4% inflation rate. Inflation in line over the last 5 years and over the last 20 years at around 6%. And we can see they are in fact a recent dividend aristocrat. Dividend aristocrats are companies that have increased those dividends for 25 years or more. Now, in terms of dividend yield theory, we have another sign of undervaluation, both on the dividend yield as well as that 5-year average forward PE being higher at 23 than the current of 18.4. When we compare it, it is pretty much near in line with the consumer staples sector P at 19. Now, when we take a look at the free cash flow payout, what we can see here, it has been very, very inconsistent. 2023 at 98%. What this means that nearly the amount of dividends the company is paying out is what they are generating in free cash flow. It is a red flag indicator, but over the next 12 months, they are expecting this to come down to 72%, which is near enough our preference as a max for consumer staples industry. Free cash flow per share, what's the story here? Well, it has doubled from 2014, or just nearly at 46 cents, to 81 in 2023. But do note the inconsistencies. We do see a very strong period of growth before falling in 2020 and then picking back up and then falling again. But again, in 2024, they are expecting this to pick up. So something just to be aware of. Sales growth, remember, 3 to 7% is what we target. The last 3 years have been fairly positive. In fact, the last 2 double digits, but we do see some years in their sales history of negative growth. Numerically speaking then, 10 billion in 2014, 17 billion in 2023. This is a company that does increase their top line, but not as consistently as maybe you would like to see. Shares outstanding, they do share buybacks. As we can see, they have bought back shares over the last 10 years. Maybe again, not as consistently as you would like to see, but it is a bonus to the investor. ROIC above that 10%, very nice to see. The last 3 years, in fact, it has been increasing from that 2013 position. So that is very positive, gives me faith in management and their ability to move this company forward. One thing that is very, very nice to see, typically on the channel, the consumer staples industry, we do find companies struggling to hit that 16% or more in terms of the margins. DEO, as we can see, consistently around that 30%, very positive to see, and a fairly similar story on the free cash flow margin. Although it has dipped to 11%, it's still well above that 7% minimum. Finally, the net debt to EBITDA, again, well below that 4 at 2.6 in 2023. It is expected over the next 12 months to increase, something to keep an eye on, but so far the balance sheet does look strong as well as that dividend safety. Now, when we take a look at the valuation, as always, if you enjoy the content, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, do click on that pinned comment below. So we get a current price of $145, a margin of safety. Again, we start off with 10%, and we can see it is pretty much just under $1 shy. So we believe for DO, you are locking in around a 10% margin of safety. In terms of Wall Street, what do they say? Well, they do believe, in fact, there to be 10% upside, near enough in line with our intrinsic value. So in conclusion, for DEO, we see around a 10% margin of safety based on our estimates and judgments, with around 10% upside per Wall Street targets over the next 12 months. Now moving on to the third stock, we have PAYC, Paycom Software. Now this is one that has suffered massively year to date, down 32%, trading towards the mid to lower end of the 52-week range, with a small yield of 0.54% that they have recently started to pay. Now again, if this is one you have been holding over the last 10 years, you can see it has dropped significantly from its all-time high towards the back end of 2021 at $550. In fact, that is more than double the current trading price. So again, they have been recently paying the dividend, so we don't have a dividend safety score just yet. Market cap 12 billion, it is a large cap company. Now in terms of their free cash flow payout, in terms of this recent dividend, it is fairly low over the last 12 months at 15%. Again, it is still forecasted to be much lower than that 60% maximum, so this is one that I do believe will start to increase their dividends double digits over the next few years. Free cash flow per share, very, very positive. It started off at nil in 2013. Just under $4, and I quite like the consistency. Yes, some years it has grown more than others, but it is moving in the right direction. 2023 expected 516, 2024 expected even higher. This is a very, very positive company so far based on the metrics. What more do you want? It also has double-digit growth to the top line. It has started to slow down from the 40s we saw in 2013 to 16, but again, double digits every single year. 2023 expected to be more of the same at 26%. Total sales then, numerically 110 million to 1.38 billion, expected 1.6 in 2023. I'm liking a lot of what I'm seeing right now. They have issued some shares though from 2013 to 2015. They have diluted your position as a shareholder, but do note there is only around 58 million shares outstanding currently. ROIC, again, lots to like here, double digits above that 10% the last few years in the 20s, 2023 again 28%. Moving on to the margins, very nice to see. It has increased from the lows we saw in 2013 to 15, around the high 20s to low 30s. 2023 expected 28%. Free cash flow margin, absolute machine, well above that 7%. 17 in 2022, 18 in 2023. Now, net debt to EBITDA, in fact, what this is signaling is that it wouldn't take the company one day to pay off all of their debt net of cash on hand. An incredibly strong balance sheet, and as we can see, that dividend looks to be safe, and if I had to guess, I would expect that to increase by double digits over the next few years. Now let's jump into the valuation model for PAYC, and let's see what we are getting to in terms of our margin of safety. So the intrinsic value is coming to $246, and a current price around $208. Margin of safety, we start off with 10%. It is a buy up to 221. At 15% margin of safety up to 209. So not that far off the current trading price. So we do believe, based on our estimates and judgments, a 15% margin of safety. What do Wall Street say? Well, they believe around 20% upside. So in conclusion, for PAYC, whilst we see around a 15% margin of safety based on our estimates and judgments, Wall Street see around 20% upside to the current trading price. Moving on to the fourth company, we have NEE, Next Era Energy, again plummeted this year, down 27% towards the mid to lower end of the 52-week range with a yield of just over 3%. Now over the last 10 years, this is up around 187%, excluding dividends reinvested, and we see its all-time high at the back end of 2021 at around $93. Dividend safety score 90, very safe, 125 billion market cap. It is a mega cap company. And when we take a look at those key metrics, they increased the dividend during the last recession, around average growth during this period, and significantly outperformed the S&P with a negative 31% return. Dividend growth, double digits this year, double digits over the last 5 years, 9% over the last 20 years, lots to love so far. And when we take a look, they are also a dividend aristocrat, having increased those dividends for 25 years or more. So let's take a look at dividend yield theory. Again, that sign of undervaluation, that yield above the 5-year average significantly, as well as the forward PE sitting below the 5-year average. Now, when we compare it to the utilities sector PE, it is slightly higher at 18.5 versus 16.3. Now, when we focus on the payout ratio, because it is a utilities company and it is more volatile, we focus on the earnings. Below 75% is what we look for, and it has been, in fact, nearly below 60% every single year. 2023, exactly the same at 58%, so lots to love there. Earnings per share, consistent increases year on year, more than doubled over the last 10 years, 124 to 290, 2023, 317, more of the same. And when we move on to the sales growth, very nice to see some double-digit increases, but also do note the negative growth around 4 of the 10 years. Some could argue that cyclicality of the business, so it does make sense. 2022, though, 23% increase to the top line. 2023, 38%. Now, total sales numerically, 15 billion in 2013, 21 in 2022, 27.4 expected for 2023. Now, it is essentially typical that we see in the utilities industry that they dilute your position by issuing shares, as we see from this graph. The reason for this is to essentially fund a portion of their growth expenditures. As we can see, they do pay out a fair amount as dividends. Now, when we focus on the ROIC, above 7.5 is what we look for the utilities. They have struggled from 2018 to 2022, but it is nice to see 2023 going right up to 7%. Something just to keep an eye on, though, to ensure it doesn't dip back down. Operating margin, nice to see around that 18% or more. It was quite significantly higher than 21-22 at that 18% borderline, but 2023 is a strong year at 34%, so lots to like so far. Net debt to EBITDA, we do bump this to 5.5 for the utilities industry, something just to bear in mind, but 7.3 quite high in 2022. It is positive to note it is shooting right back down to 4.78 in 2023, so it isn't something that is a worry, but something that you can keep an eye on moving forwards. So let's jump into the valuation for NEE, and as always, do click on that pinned comment below. You can grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or those on your watch list. Current price then $61. If we start off with 10%, it is a buy up to $64.76, and at 15% pretty much at the current trading price. So for Next Era Energy, we do see around 15% margin of safety. In terms of Wall Street and what they forecast, well, they see around 15% upside. So in conclusion, for Next Era Energy, we see around a 15% margin of safety to the current trading price, with Wall Street expecting around 15% upside over the next 12 months. We then move on to stock number 5. We have RTX Corporation, Raytheon Technologies. Again, suffered this year, down 17%, trading towards the mid to lower point of the 52-week range with a yield of 2.8%. If you've been holding this over the last 10 years, we do see a very choppy up and down over the period. You'd only be up around 18%, and we can see its all-time high at the beginning of 2022 at over $100 at just under 105. Now, in terms of the dividend safety, we see a score here of 70, making it safe, a 121 billion market cap. It is a mega cap company. Now, they maintained the dividend during the last recession, had average growth, and had a near S&P return at negative 52%. Dividend growth, we can see 7.3% over, in fact, this year, which is nice to see above that inflation. Over the last 5 years, we see negative 5%, and over the last 20 years, 8% year on year. And we can see they did cut that dividend in 2019, and therefore they've only had 1 year of consecutive dividend increases. Now, in terms of dividend yield theory, we can see that undervaluation sign, the yield at 2.8 versus the 5-year average of 2.38. Forward PE 16.5, it is below the 5-year average of 19, so another sign of undervaluation. Likewise, the industrial sector PE sitting higher at 19.8. Now, when we take a look at that free cash flow payout, we do see 2021, 2022 above that 60%, and 2023 again expected to be higher. So something just to bear in mind, but for now that dividend does look safe. But do note in 2020 and 2016, something you wouldn't have noticed if you focused on the earnings, that they were paying out more in those 2 years in dividends than they generated in free cash flow. So something just to think about as an investor or potential investor. Free cash flow per share, not the greatest, 509 in 2013. It did come down to 298 in 2022 and is expected to only increase slightly more in 2023. Something just to think about what type of company you are investing. Not all companies will have consistent increases or sharp shooting increases neither. Sales growth, we can see very, very inconsistent. Double-digit decrease in 2018, but then from that point they had some double-digit increases, kept in line with inflation in 2022. 2023 expected to be below that at 2%, so it is very inconsistent. And when we take a look, 57 billion in 2013, 67 in 2022, and we do see it dip down in 2018. So very inconsistent, but it still is increasing over the last 10 years, just probably not in line with inflation. Shares outstanding, we can also see they have diluted your position as a shareholder if you were an owner from 2013, as it has increased. But in 2021 to 2022, we do see they did buy back some shares. Now, ROIC, remember 10% or more. Pretty much 2018 to 2022, it has been below that 10%. 2023 expected even lower at 4%. So something just to bear in mind. I would like to see them go back up to that 2013-2017 period where we saw double-digit increases. Operating margin, again, it has slipped from around 2019 to below 12%. It did pick back up in 21-22, but we do see it drop down in 2023. Free cash flow margin is straddling pretty consistently around that 5% year on year. Finally, we get to the net debt to earnings before interest, tax, depreciation, and amortization. 2.31 in 2022. It is expected to creep higher in 2023 at 2.44. Still, I am happy with that dividend personally, but something, again, just to keep in mind as an investor or potential investor. So let's jump into the valuation for Raytheon Technologies. As always, if you enjoy the content, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And just let me know whether or not you are liking these type of contents on a more regular basis. Margin of safety then, intrinsic value of $97. 10% is a buy up to $87.42. At 15%, we can see it isn't just quite there yet. So we believe Raytheon Technologies have around a 10 to 15% margin of safety based on the current prices. And Wall Street, they forecast the price to go slightly lower than the intrinsic value with around 5% upside. So in conclusion, for Raytheon Technologies, we see around a 10 to 15% margin of safety, with Wall Street only really expecting a 5% upside over the next 12 months. As always, when you do run through these videos, do let me know your thoughts below whether or not you agree with these undervaluations or overvaluations as we run through. We then move on to the final sixth dividend company, which is Tyson Foods. Now, this is down 16% year to date, again towards the mid to lower end of the 52-week range, with a yield of around 3.65%. Now, if you've been holding this over the last 10 years, you would be up around 61%, and we do see its all-time high at the beginning of 2022 at just under $100, so nearly twice the price of the current trading value. So in terms of the dividend safety, it sits at 80. It is safe. Market cap just under 20 billion, a large cap company. Recessionary metrics, they maintained the dividend during that period. Pretty much flat sales, but that was above the average growth, and they had essentially a near recession return at negative 55%. Now, dividend growth this year was very poor. In fact, last month at 2%, well below that inflation that I always advocate on the channel, which was disappointing when we saw over the last 5 years double-digit increases as well as the last 20 years. Now, they have only been increasing those dividends for the last 11 years. Now, let's jump into dividend yield theory. We can see that undervaluation sign, 3.65% versus the 5-year average of 2.45. But then on the forward PE, we see a different story, sitting at 27.5, significantly higher than the 5-year average. Now, when you compare that, the consumer staples sector PE is significantly lower at 19. Now let's jump into the free cash flow payout. Now, something just to bear in mind, we do see here with a company when they do make losses, that free cash flow is negative. So we see a significant drop here. But even on the preceding year at 83%, it is still higher than even the 70% that you look for in the consumer staples. So something to bear in mind moving forwards into 2024 with Tyson Foods. Free cash flow per share then, we do see it increase from 154 to 725 in 2021, but over the last 2 years it has gone down, although 2024 it is expected to pick back up and go to positive. Sales growth then, they have had some different years, some years of double-digit growth followed by negative double-digit growth, and then years of just keeping up in line with inflation. 2022 was strong double-digit to the top line. 2023 though, it did drop to negative 1%. And when we look at that numerically, 37 billion in 2014, 53 in 2023. Now, they do share buybacks. They also issued shares from 2014 to 15, but from that 413 million, in fact, shares outstanding, it did drop to 354 in 2023. So they do share buybacks, and maybe not as consistently as one would like, but it is something they have on their radar. ROIC then, we can see pretty much over 10% for the majority of the last 10 years, although do note it did slip significantly to 2% in 2023. Then the operating margin, this is something that we do typically see in the consumer staples, and we do pinpoint those in this industry that we do say is quite a surprise. As I mentioned, we do typically see below 16%, although we like to see more. 2023 though, it did get squeezed massively at 1%, and with margins being squeezed, it means that bottom line net income will also be squeezed, and therefore not giving those increases we love to see as investors to the dividend. Free cash flow margin, again, it has been below 7% over the last 10 years. Net debt to EBITDA, then, what we can see, around 4 is the maximum for consumer staples, 3.31 in 2023, and 2024 it is expected to come down. So we can see that dividend does look to be safe for now based on the information we have, and the balance sheet does seem to be strong based on the information. Now, in terms of the valuation model, let's jump in and see whether or not this is significantly undervalued, and we have an intrinsic value of $59. Now, the current pricing at $53.67, if we take a look, we can see it is currently a few cents shy, so we do believe there to be around a 10% margin of safety to the current trading value. In terms of Wall Street, well, they believe there to be less than 5% upside over the next 12 months, so I would be interested to hear your thoughts. Is this one you agree with, or do you believe Tyson Foods will go back up to over $90 that we saw not too long ago? So in conclusion, Tyson Foods, we see around a 10% margin of safety, with Wall Street expecting not more than 5% upside over the next 12 months. As always, if you've enjoyed the content, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And don't forget to click on that pinned comment below where you can grab the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio. As always, drop your comments below, catch you on the next episode, and take care.